On this board, we're talking about conventional loans. What are conventional loans? Conventional loans are mortgage loans that are not insured or guaranteed by the government. They are not part of any specific government program. There are two types of conventional loans. What are the two types of conventional loans? The two types of conventional loans are conventional conforming loans and conventional non-conforming loans. What are conventional conforming loans? What does that even mean? Well, conventional conforming loans are conventional loans that conform to loan limits, down payment requirements, borrower income requirements, debt to income ratios, and other underwriting guidelines established by Fannie Mae and Freddie Mac. What are conventional non-conforming loans? Well, conventional non-conforming loans are conventional loans that do not meet the standards of Fannie Mae and Freddie Mac. Now, what are some examples of non-conforming loans? Non-conforming loans. Well, three examples of non-conforming loans are jumbo loans, Alt-A loans, and subprime loans. What are jumbo loans? Jumbo loans are loans that exceed the loan limits established by Fannie Mae and Freddie Mac. What are Alt-A loans? Alt-A loans are loans made to borrowers who do not represent the high credit risk of subprime borrowers, but do not quite meet the underwriting requirements to qualify to be a conforming loan. What are subprime loans? Subprime loans are loans made to borrowers who have a credit history that reflects significant derogatory issues, or borrowers have a combination of credit issues and documentation issues. In general, what are some of the basic guidelines, general guidelines of conventional loans? Well, here are some general qualifying guidelines regarding conventional loans. All right, now keep in mind, these are just general guidelines, right? There's always exceptions and stuff, but these are just general guidelines regarding conventional loans. Generally speaking, the total housing expense ratio cannot be more than 28%. Now, what is the total housing expense ratio? How do you calculate that? What is it? So here it is, the housing expense ratio, and is also known by another name. What's the other name for the housing expense ratio? It's also called the front end ratio, all right? The housing expense ratio, also known as the front end ratio, is the percentage of your gross monthly income devoted to housing expenses. So to write that out as a calculation, you would take the total housing expenses divided by the gross monthly income, and then multiply that by 100. Now, another way to do this calculation, right? Another way to write this out is take the PITI divided by the gross monthly income and multiply that by 100. What is the PITI? Well, the PITI is your total housing expenses, but what does that really represent? PITI, what does that represent? That represents principal, interest, taxes, and insurance, PITI. So if you take your principal, interest, taxes, and insurance, you add that all up and you divide by the gross monthly income, you multiply by 100, that gives you the total housing expense ratio, right? And in general, that total housing expense ratio cannot be more than 28% regarding a conventional loan. Now, another general guideline is the total debt to income ratio. The total debt to income ratio in general regarding a conventional loan cannot be more than 36%. How do you calculate the total debt to income ratio? And what is it really, right? Well, here it is. The total debt to income ratio is also known by another name. What's the other name for total debt to income ratio? It's also called the back-end ratio. And it's also called the total obligation ratio, all right? So the total debt to income ratio is the percentage of your gross monthly income devoted to paying debts. But keep in mind that debt with 10 payments or less remaining is not counted in this calculation, right? So debt with 10 payments or less remaining, it does not count, is not counted in the calculation of the total debt to income ratio, all right? But keep in mind that legal obligations such as child support and alimony is counted, right? You have to include legal obligations such as child support and alimony in your calculation for debt to income ratio, right? Now, how do you do the calculation? Well, you take your total monthly debts, right? Divided by the gross monthly income, you multiply that by 100, right? And when I say debts, I mean debt payments, right? Debt payments, all right? You multiply by 100 and you get your total debt to income ratio, right? And I mean, specifically, these would be like the minimum payments that you have to pay on the debt, right? To figure out your total monthly debt payments, right? So the total debt to income ratio cannot be more than 36%. Now, another general guideline regarding conventional loans is 2 months of reserves. The borrower must have 2 months of reserves. What does that mean? It means that the borrower must have 2 months worth of their housing expenses in savings, right? 2 months of reserves, right? Now, what's another guideline is down payment of at least 5% or 3% in some cases for first-time home buyers, right? Now, if the borrower does not have at least 20% down payment, the lender will normally require the purchase of PMI. What is PMI? What does PMI stand for? PMI stands for private mortgage insurance. Another thing to note about conventional loans is the late fee. What is the late fee that is charged regarding borrowers who have a conventional loan in general? What is the late fee? The late fee is 5%. 5% is the late fee that is charged. But now keep something in mind. The late fee applies only, it's 5% of the monthly P&I, right? Not the whole PITI, right? So it's only 5% of the principal and the interest. It does not, that late fee does not apply to the taxes and the insurance, only to the principal and the interest. Now, what are some examples of required documentation regarding conventional loans? Well, it depends on the situation of the borrower. Now, if the borrower is a W-2 employee, right? They have like a regular job, right? Then the lender is going to require pay stubs for the most recent 30-day period and W-2s for the most recent 2-year period. Now, if the borrower is self-employed or if the borrower has more than 25% of his or her income from commissions, or if the borrower owns 25% or more of a business, then they must provide up to 2 years of their tax returns. Now, what if the borrower is a recipient of non-tax income, right? So recipients of non-tax income, such as Social Security, public assistance, and disability, they must provide comprehensive documentation relevant to the type of income. Now, something to note though about recipients of non-tax income. They are permitted to gross up their non-tax income by 25%, right? Now, why would that be allowed? Well, because think about this. In a lot of these calculations, we're using the gross income, right? Before taxes. But if a borrower is a recipient of non-tax income, right? Well, that's not taxed. And so therefore, to make things equivalent, right? The law allows for the non-tax income to be grossed up by 25%. Now, what about commissions? How is that handled? Well, regarding commissions, we take the average of the most recent 2 years of income. And what about bonus and overtime pay? Well, same thing. We're going to take the average income for the last 2 years. So to recap, conventional loans are mortgage loans that are not insured or guaranteed by the government. They are not part of any specific government program. And there are two types of conventional loans. There are conventional conforming loans and there are conventional non-conforming loans. All right. By the way, all of this is just like a brief overview, right? For those of you that are studying to become a licensed MLO, a licensed mortgage loan originator, right? If you're studying to take the MLO test, I highly recommend that you really get into a really great exam prep course. The one I'm taking is called Affinity, and I absolutely love it. I believe it's the best MLO exam prep course out there, right? I'm taking the mastery course and it is wonderful, wonderful. And so so for those of you that are studying for the exam, I really highly recommend that you check out the Affinity Mastery Exam Prep course. All right. So if you have any questions or comments, please leave them in the chat box below, and I'll see you next time on the next episode.